Hey, what's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan. I'm the mind behind Make More Capital, and today we're going to cover the Q1 earnings from Cresco Labs and Ayer Wellness. So before we jump in, if you enjoy this video or you learned something, please just leave a like on it as it really helps out my channel. And then of course, if you want to learn how to take advantage of this generational investment opportunity, make sure you subscribe below so that you don't miss any future videos. And then there's plenty of content for you to go back, rewatch, and educate yourself with. I've tried to put all the news stories and facts in one place so that you can watch how the industry's evolved over time, try to identify some top companies that you think are going to be around for a while, and then take advantage whenever you are ready. And as of 8 a.m. Eastern Standard Time on Friday, May 28th, there is still no news from Chuck Schumer or Gerald Nadler, which is a sad sign of the times as we've come to expect only lies from politicians. But guess what? They've given their word multiple times over and over, so the bills will still need to get introduced at some point. So the good news is that cannabis has trended green regardless. Even LPs are looking good as US firms and investors are anticipating some news just as we are. So fingers crossed on Sunday that I'll have some sort of an announcement from today, but if not, take a deep breath, smile, and enjoy the long weekend because the fundamentals are as strong as ever, as I've shown in past videos with other MSOs, and we're going to relay today. And that means if we haven't seen the catalysts yet, they are still to come. So we're going to jump into Cresco's earnings and go through their first quarter 2021 financial results under US generally accepted accounting principles. And the highlights are that they report record revenue of $178 million, but they expect to reach annualized revenue run rate of more than $1 billion by the end of 2021. So based on how everything is looking right now and what they're projecting into the future, they expect to do over $1 billion in revenue in this calendar year, even after just bringing in $178 million. So that's very positive coming out of Cresco. The revenue is $178.4 million, which is an increase of 9.9% quarter over quarter and 168% year over year. While we see the breakdown, their record net wholesale revenue was $95.6 million, an increase of 5.7% quarter over quarter and 150.8% year over year. And keep in mind, they are the largest branded wholesaler in the US, so we can expect this to be top numbers for any wholesaler that comes out. But on top of that, record retail revenue of $82.8 million from 24 stores, an increase of 15.2% quarter over quarter and 193.2% year over year. So very strong growth out of Cresco, which is why I invested in them in the first place. They're growing rapidly, especially as they're going after the consumer packaged goods approach and trying to wholesale as opposed to opening as many dispensaries as possible. Now in Q1, we delivered sequential growth from existing assets, demonstrated our ability to reach and sustain #1 market share positions in 2 of the industry's top 5 states, and we're getting up to repeat that success in more markets this year. We're accelerating growth through a diverse set of initiatives, including several organic expansions and mergers and acquisitions that will benefit the company in subsequent quarters. In order to execute all of our pending growth initiatives, we invested in the operating platform to support the growth. We laid the groundwork in Q1 and Q4 of, I imagine, 2020 and Q1 2021, which has just passed, and now our expertise with integrating new assets and producing operating leverage will kick in, says Charles Bachtell, co-founder and CEO of Cresco Labs. So if we jump down, we can take a look at some of their M&A activity, and basically in the first quarter they just highlighted that they closed their acquisition of Bluma Wellness in Florida, giving them a footprint there. They also closed their acquisition of 4 Ohio dispensaries operated by Verdant Creations, so they will then get dispensaries on the ground in Ohio. Plus, they closed their acquisition of the Massachusetts operator Cultivate license. So the closing of these acquisitions should add to future revenues in upcoming quarters in key states like Florida, Ohio, and Massachusetts. And they mentioned that they invested a lot in Q4 and Q1, so it's timely that they spent more money previously so that hopefully they'll be seeing it come in Q2, Q3, and Q4 the rest of the year. And on top of that, March 31st, 2021, current assets on their balance sheet were $381.7 million, including cash and cash equivalents of $255.5 million, while the company had a working capital of $105 million and debt of $187.9 million, while the total outstanding shares on a fully converted basis was 399,018,710. So if we scroll down to the bottom, I want to just take a look at their last year's numbers. So this is all of 2020. And I just wanted to point out that most of the growth that they saw came from Q1 to Q2 and then Q2 to Q3. So I'm just mindful of that and anticipating something along the same lines this year in hopes that, it's Q4 and Q1 where they typically try to invest in any organic expansion and really try to ramp up the growth in Q2, Q3. And obviously, if they're aiming to do $1 billion in run rate, they must have sort of the same idea. Well, I especially will be looking out for the Q2 to Q3 growth, where we saw last year they increased their gross profit margins from 33.7% up to 50.1%. So if we go take a look at their revenue from the recent quarter, $178.4 million is what they brought in Q1 2021, up from $162.3 million in Q4 of 2020, and up from $66.3 million from Q1 2020 a year ago. Their cost of goods sold, which is what they spent to bring in this revenue, increased but only slightly compared to revenue, up to $91.4 million from $87.8 million. So if we compare, they increased their revenue by about $16 million, and their cost of goods sold only jumped by about $4 million. So this does leave them with more profit, bringing in $87 million after subtracting cost of goods sold for gross profit of $48.8 million. Now, if we look at their operating expenses as well, we can see that their costs, their SG&A actually went down in Q1 from last quarter. So they only spent $70.7 million, down from $74.1 million, which means they're keeping more money in the business, leaving them with a positive operating income of $16.2 million. Also a nice increase from $329,000 last quarter. But then, of course, we have to subtract expenses, taxes as well, and we know cannabis is taxed more than any other industry out there. So they did suffer a net income loss of $24 million, but that is substantially less than they did last quarter. But keep in mind, they did say above that they invested more in Q4 of 2020 and Q1 of 2021 in hopes then that their operations in the coming quarters will make up for what they spent and hopefully bring in that increasing revenue that's going to get them to $1 billion run rate. Now, if we look at their balance sheet, their intangible assets and goodwill is quite high, something that you don't want to see. Mind you, this is very common for cannabis companies, especially those that have acquired some new ones to bring in or to add to their operations. However, they've got plenty of cash on hand with $255 million and $126 million in other current assets. So for the next 12 months, they can cover their current liabilities, and as long as they continue to execute and grow their revenue while cutting costs, I see Cresco becoming profitable by the end of the year. And then if we look at their EBITDA numbers, we take a look at their net loss, we add back all of these costs, depreciation, amortization, interest expenses, taxes, for a positive EBITDA of 12.8. And then all of these one-time costs giving them a positive adjusted EBITDA of $34.9 million. So all in all, these are very strong numbers from Cresco. And I think, again, the thing to highlight, their financial outlook, the company is providing the following guidance for the rest of the year. Annualized revenue run rate of more than $1 billion by the end of 2021, gross profit margins in excess of 50% in the remaining 3 quarters of 2021, and an adjusted EBITDA margin run rate of at least 30% by the end of 2021, as they continue to eat up wholesale and retail market share in the top populated states that they're in. So I'm very happy with those earnings as a Cresco shareholder. Now over to Ayer Wellness. They report their first quarter 2021 results with Q1 revenue up 74% year over year to $58.4 million. For a first quarter adjusted EBITDA of $20 million on an IFRS basis, or $18.4 million on a US generally accepted accounting principles basis, up 136% year over year, and that is a decent portion of the revenue they brought in. So that's healthy profitability numbers out of Ayer Wellness. Their US GAAP operating loss, though, was $8.4 million, which included non-cash and one-time expense of $26.5 million. While they're happy to announce they closed on the acquisition of Liberty Health Sciences, giving them the 4th largest footprint in Florida with 42 retail dispensaries, and they also closed on their Arizona and Ohio acquisitions, bringing total footprint to 6 states, 7th state, New Jersey, expected to close this summer, allowing the company to provide second quarter 2021 guidance for an estimated of $90 million in revenue, up from $58.4 million. So if they can manage that, that will be a nice jump. And they're happy to announce Q1 2021 represents the early innings of our 2021 strategic transformation as we successfully closed on our announced acquisitions as scheduled, starting with the February 25th closing of our acquisition of Liberty Health Sciences, adding the 4th largest retail footprint in Florida, said Jonathan Sandelman, CEO of Ayer Wellness. We then closed on our Arizona acquisition at the end of March, adding 3 dispensaries and a large cultivation expansion in the latest adult use market to ramp up in the West. Then we quickly followed that by closing our acquisitions on Ohio and harvesting our first flower in Pennsylvania, which hit the shelves in our stores earlier this month. We also opened our 6th store in Nevada, the closest dispensary to the Las Vegas airport, just in time for the return of tourism to the state. So the results of our successful execution thus far can be seen in our April monthly revenues, which have nearly doubled since January. We expect step function growth across Q2, Q3, and especially Q4 2021, with further milestones reached when additional cultivation projects come online and we close our New Jersey acquisition later this summer, Mr. Sandelman continued. So we'll scroll down to the bottom and take a look at their numbers and see what Ayer Wellness managed. So let's start with the bottom of the barrel. No, we'll go here. So revenues, net of discounts, they brought in $58.3 million, up from $33.5 million a year ago. While their cost of goods sold increased to $33.9 million, up from $16.8 million last year, leaving them with a gross profit of $24.4 million, up from $16.6 million a year ago. Now, if we look here, the only thing we noticed that actually increased by 100% year over year was their cost of goods sold, and it seems here there was an incremental cost to acquire cannabis inventory in a business combination, so they ran out of cultivation and they needed to buy from someone else, so they spent $5.7 million doing so. As you can see, obviously you want to make sure you're reducing your costs of goods sold and increasing your revenues and your gross profit as opposed to the opposite. So at least Ayer Wellness knows that they have their work ahead of them cut out. And for the rest of this year, especially in Q2, Q3, and Q4, their goal will be to increase that revenue while cutting costs to make them profitable sooner than later. Another great way to do that is to reduce your expenses as well. So we'll see if they did that. Total expenses did increase year over year from $25.2 million up to $32.8 million. Most of it coming from acquisition expenses, a jump in their general and administrative, sales and marketing, but it's good to see that their stock-based compensation actually decreased by $4 million, leaving more money in the hands of shareholders, leaving them with a loss from operations though of $8.3 million, a slight improvement from 1 year ago of $8.5 million. And then if we scroll down after applying all the taxes that only cannabis companies have to go through, leaves them with a net loss of negative $16.6 million, which is actually more than they lost a year ago at $14.3 million. One thing to point out here though is why Ayer Wellness' share price is so high and expensive, around the $40 range, is because they only have $43.9 million, or they only have 43.9 million shares outstanding. So because there's a much smaller share float, their share price is a lot more expensive, similar to why Trulieve and Green Thumb are more expensive than Curaleaf and Cresco Labs. But for a smaller MSO, Ayer Wellness has put themselves in a great position as long as they continue to cut costs and increase their revenue, as they're sitting on $195 million in cash, and their current liabilities are just $62.6 million. So for the next 12 months, they got plenty of cash to cover anything that might come against them. Only thing I wanted to show you is that they've got a lot of cannabis inventory still, so that's something taking note, especially considering a year ago. And just like every other cannabis company, lots of intangible assets and goodwill, so the goal is to try and find the most profitable cannabis companies with the least amount of added fluff on their balance sheets. So if we scroll up here, if you are invested in Ayer or you do want to consider investing in them, then you'll want to grab the link below and take a look at their updates in each individual state, but I'm not going to go through them because they're more general. I'm just going to stop here and go through this breakdown that they share that I do think is quite nice and quite clear. We can see the states that they're getting into: Massachusetts, New Jersey, Pennsylvania, Ohio, Florida, Arizona, and Nevada. Shows us the population for every single state. So they're going after an addressable market of 72.5 million people. Whether the state allows adult use or medical, AU for adult use, med for medical, / for both. I mean, it seems like neither of the state has both. With an estimated 2021 market size, in revenue numbers, $1 billion, most of these states being close to or upwards of $1 billion, except for Ohio, where they don't actually have any dispensaries. The dispensaries they have open currently, and what they anticipate to open by year-end 2021, they currently have 51 open and expect to have 64 open by the end of the year. In key retail markets, all of these cities that you likely know by name, with lots of foot traffic, and that foot traffic will increase post-COVID as well. And they are ramping up their cultivation and production. So what we see here is what they currently have and what they anticipate to have by year-end 2022 in square feet, going from 554,000 square feet to over 1 million square foot cultivation room. Their employees, seems like they've got a good amount of employees in each state, so this isn't a company that's going anywhere because they want to continue to employ more people and provide more jobs. And with their total planned CapEx costs, should run them about $136 million till the end of 2022. So fairly good numbers out of Ayer, but I wanted to highlight this. Their outlook, based on the results to date, management is expecting second quarter 2021 revenue of approximately $90 million. So again, a jump from $58.3 million, that's a lot, which reflects growth of 54% quarter over quarter and 218% year over year. That's where the year over year growth is going to be. With their adjusted EBITDA margin on US GAAP basis is expected to remain in the 30% range in Q2, reflecting the investment in new markets and growth projects that are expected to generate more meaningful revenue in the second half of 2021 and 2022. But get this, The company is reiterating its target for 2022 revenue of at least $725 million on a US GAAP adjusted basis. It is also reiterating its guidance for 2022 adjusted EBITDA of $300 million, which is comparable to $325 million on an IFRS basis. And if they can manage an EBITDA of this, which is, would make up a large portion of $725 million, that gets their margins up to healthy amounts, close to 50%. And that would be phenomenal if Ayer can pull that off. So just wanted to go through that. Then this is also just sort of the similar breakdown from what we saw down there. But again, revenue increased 74% year over year, 88.4% year over year, with their adjusted EBITDA increasing 136% year over year. But as long as they continue to cut costs while growing in these key states that they plan to do so, they should be in good shape. And that is it for today's episode. So thank you so much, everyone who tuned in. I hope you got some value out of it. Which company would you prefer to invest in, Cresco or Ayer? Let me know in the comments. Is there any reason you wouldn't want to invest in either of them? Let me know as well. Let's have a discussion, because I just want to help prepare you investors to capitalize on this opportunity, especially as the trend starts to change. So if you enjoyed this video, please leave a like on it, as it really helps out my channel. Subscribe below if you don't want to miss any future videos, and I will catch you on Sunday for This Week in Cannabis. Have a great day, everybody.